There we go. Here we go. Thank you so much, Denise. And hello again to everyone. It's so good to see everyone here. I am super stoked to have so I think your network should be mostly made up of your friends. So I am thrilled to have my friend Joe Cope here with us today. So full disclosure, Joe is also my financial advisor, but we met where you should always meet your financial advisor at church, because that'll make sure that he's actually honest about things. So Joe and my husband Rustin used to do Sunday school with the 3-year-olds, and so that is the way that you create camaraderie over the markets, is by teaching 3-year-olds how to sing and dance and talk about Jesus, I guess. I was always just one passing out bulletins, and frankly, you don't want me to be that person on a Sunday morning passing out bulletins, because I said you'll get a good or morning because it's too early. That being said, I'm so happy to have Joe here. I'm going to read his bio, and then we're going to jump into our chat. Joe Cope is the co-founder and managing partner of Cope Corrales, a business and wealth advisory firm in Washington, D.C. Joe works with clients nationally, helping families build better futures. He's a passionate communicator and educator. He values building trust with his clients and delivers guidance in a digestible and relatable way. Approaching 2 decades as an advisor, he specializes in strategic wealth management, advanced estate, and tax planning. He is proud to co-lead a fantastic team at Cope Corrales in delivering clients a true family office experience. And I can also attest that they are an amazing team, and I'm pretty sure the Washington Business Journal just recently gave them an honor for very much the same thing. So I think we can jump in by my first question to Joe is sort of kind of one of clarification, but sort of, I think I and probably other emerging managers are inclined to think of high net worth individuals as sort of the kind of a way for them to get started. And so the gateway to high net worth individuals would generally be a wealth manager. So can you sort of verify that for me, and then also lead into the real first question, which is, what are some of the things that are important to high net worth individuals that wouldn't matter to, say, a pension or an endowment? That sounds very obvious, but I want to get to the obvious and then the not obvious with that question.
Awesome. Vanessa, good to see you and see everybody else. It's nice to be friends with people in personal and professional. It's like, it's the best type. It's great to meet all of you guys. Congratulations on, I think, just being on this call, wherever you are. If you're starting a fund, working with Vanessa, or thinking about it, already have done it. It's incredibly difficult, and yet it's incredibly rewarding, as I believe all entrepreneurship to be. I'd say about 80 to 90% of our clients are entrepreneurs. The ones that are most successful, they all have a business of some type. And a fund is a really incredible way to go. I think we'll go high level. I'd love this to be interactive too. If you have a question, please feel free to unmute, put something in the chat, whatever you'd like. Love to answer things if that's all right, but kind of as they come up.
Please do.
And I don't know where kind of everyone is on their journey, so forgive me if you're way far or before. I don't know exactly where everyone is. What I would say is, in thinking about high net worth individuals and starting a fund or doing anything in that world, you're likely to get to them before you get to me, right? And that's mainly because whenever you're starting a fund or some type of project, I typically assume and have seen that people are exiting out of a larger organization of which they've had experience either in the VC, PE, or real estate world. And they want to do something bigger, better, make more money, kind of do a different investment thesis, do a different flavor on what they've already experienced. That's usually my assumption, right? That there's some type of proclivity or experience there, and that's what they want to do. And the first place to go when kind of raising funds is going to be friends and family. And everyone goes to friends and family, and they generally know who is the friends and family who have money. And the reason to do that is not just the resources, but is the level of trust that you already have. Typically, they're personal relationships, and they trust you. and they're willing to take your word for it. They're willing to take a risk on you. They want to see you do well. And like, that is the most powerful thing that you have, right? Which is the ability to move past the slide deck, like beyond your pitch deck, beyond your thesis, beyond all the stuff that you're pouring your heart out and working with an editor to do, right? But is to like, they'll just give you the benefit of the doubt, typically. I also have realized when I first started my career that the people I expected to do business with me did not, and the people I did not expect do. Yeah. It's this weirdest thing in the world. I'm like, that guy would totally be my client. He wanted nothing to do with me. And then the person I never thought would was like really excited to give me a chance. So I learned that, and I still learn that early on and an ongoing basis. So with that said, I think that's the place always to start, is high net worth individuals who are going to have the capital needed to be able to take the risk needed to invest in you early in your career. Now, what will happen when you go to those people who have advisors? That's something I think I can comment on. Okay. So there are two main types of financial advisors in this world. They are fiduciary and non-fiduciary advisors. In the non-fiduciary world, these are actually the large brokerage houses. They're UBS, Morgan Stanley, Merrill Lynch, any insurance broker dealer, anybody who has a broker dealer associated with their name will not, or should not, and most likely will not give advice to their clients on what you are presenting to them. If they give advice, this is super important. If they give advice on your fund or on your investment opportunity, they are doing something called selling away, which is a fireable offense under FINRA rules.
Interesting.
Anybody, this is very important. If they, that's called selling away. What's called selling away is these broker dealers, which are again the largest wirehouses you can think of, have rules, and they set their own rules, and those rules are managed by FINRA, which is an SRO. It's a self-regulatory organization. That FINRA enforces the broker dealer's own rules, and the broker dealer says that our advisors who work for us cannot advise our clients on anything other than the things that we approve. And you, my friends, are not yet approved, right? There may be a KKR fund. There may be something on Blackstone that there's some type of channel in there, but anything you're bringing to the table. So if you walk into a client, you walk into any advisor, a large workshop, but if you walk into any client, they say, I need to talk to my advisor, and they bring their idea to that advisor should not and likely will not be able to comment. In fact, they may tell them not to do it because for a variety of reasons. Maybe they just say, hey, we're not comfortable with that. But usually most people aren't willing to say it's not in our, it's not in our wheelhouse to make comments on it. Right. So they'll just say we discourage it because they also might lose the business. If you're asking for $500,000 or $100,000 and that's part of their portfolio that they're managing earning fees on, they may say, actually, we're going to just say, don't do that for blanket reasons so that they can keep the assets. Okay. So you're very likely to run into advisors who maybe it's a good idea, maybe it's not, but their own interests will really count against you, and then their own careers will count against you because they can't have those conversations. Okay, so I don't know if that's helpful, but that's a roadblock that you may run into on the high net worth side.
I had never heard of that. That is an illumination for me.
Yeah, and these are the biggest brokerage houses. People don't know that these places, they can only sell, if you will, sells maybe in quotes, or advise on the things that their firm either A, approves, or B, promotes. And that's the other part that's kind of the dirty secret in wirehouses. A lot of things that end up in portfolios come from higher up. They say, hey, we're going to create these. Sometimes they have higher fees, sometimes they don't, right? Again, but this is kind of the world of a brand name. You're getting kind of this limitation in service.
That is super interesting. Yeah. That's super interesting. Does anyone have a question related to that? Because my mind's
so I've got two questions. So I think it's very important that you brought that up. And I have a friend of mine who was at a pretty big clearinghouse, actually lost his license.
That's right.
Because of that. Literally, he was involved in something, showed it to someone, they bought into it, the investment went south, and then that's when the poison well had been exposed. Second, I've had situations where individuals have had to sign a waiver. Like they're the street name for it's like big boy, they're putting on their big boy pants that, hey, I'm savvy enough to know what this is and I'm going to do it, but I'm indemnifying, UBS so that there's no blowback if that was the case. So I've kind of seen it in my time both ways, where one is they were so adamant about it that they indemnified the group and said, hey, advise me on this. And the second one, I've seen it where the person didn't disclose that they had a personal financial interest in it, and they wound up losing their license and needing to rebuild what was a 25-year career and something else.
And by the way, Chad, to follow on that, it might have been a really good thing for the client. It didn't have to go south. It actually could be, you could return 100% and still that broker can lose their job.
Yeah, but that's right? When the people complain. You told me this was the next Google.
Yeah, exactly. Yeah.
No one's complaining or bringing you up on regular when they got 10x return, right?
Exactly. Yeah. No, that's a fair point. But given that, Joe, then what is the difference of the type of fiduciary you are, and how do you go about meeting managers, or do your clients bring them to you?
Yeah, exactly. So that's just again a picture of who you're talking to when you meet your high net worth individuals as you're getting started. There is a background. The alternative type of advisors that we are. And by the way, I know all that because I had worked for a broker dealer for many years, and we decided we could no longer operate under their set of rules because our clients wanted more to meet people maybe like you, wherever you are, right? So we actually started our own firm, and we are a registered investment advisor. Okay, so an RIA is registered first under the state. Once you reach $100 million under management, you then register under the SEC. Two things happen when you register under the SEC. Number one is that you are promising to be a fiduciary. And that fiduciary is a very simple definition. It's that we always act in the best interest of clients. That's number one. And then number two is that we only charge advising fees. We can earn 0 commissions, which I find absolutely the best way to do it, which is we are charging for our advice and our expertise, and it's on a fee basis. Now, why is that important to you? Is because as an investment, as a fund, if a client brings something to me, I now have a fiduciary duty to give them advice on whether something is a good or a good or bad investment, right? Whether we should do that. So if you work with somebody who's a high net worth individual, and there is in fact an opportunity, at least if they have an RIA style advisor, you have a shot at having that and partnering with that advisor in some way, and maybe saying, hey, maybe more of your clients might be interested in this. Okay. Right. So you're going to run up against, now you'll still run up against, and I'm going to give you a couple cool tools here to talk to RIA based advisors. Number one is you're still going to run up against, are you going to take money out of our portfolios? Right. So you're taking money from somebody's pockets on the advisor side. They don't like that. Right. With that. So you have to remember that, like if you're getting pushback from that side of things, that may be there. But one of the tools that we use oftentimes are things called portfolio lines of credit, which is the ability to lend against after-tax portfolios.
I'm an expert at that.
What's that?
What did you say?
But I'm an expert at that. I know all about that.
Yeah. Now, you got to be careful with those, but there are ways to kind of leverage and to use your money in one or maybe two, three ways without threatening the advisor. Okay, so there are certain options and opportunities that could be suggested. All right, so that's kind of just the background of working with advisors. And our job is then obviously to like look at the actual deal and say, is this something that's smart? Is this wise? If our clients decide to bring it. I will tell you, most clients, they might even bring it to their advisors because they've heard no so many times. They just hear no, so they don't even bother, right? And at that point, you're doing KYC, you're doing, qualified investor, you're kind of doing that route. And I mean, you're on a risk island of yourself, right? If you make some promises and you got to work with Vanetta and Rustin and the whole crew to make sure it's all buttoned up, that's highly recommended. But you may not even run into an advisor, but if you do, those are kind of the two charges.
Hey Joe, this is Brian Banks speaking. I'm out in San Francisco. I spent about 5 years working at a $10 billion wealth management firm running private capital and did oversaw about $1 billion worth of those types of investments for our high net worth clients. And one of the challenges that I faced in being the portfolio manager, subject matter expert, lead evangelist, call it what you want, was that lack of clarity, both from the client perspective, as well as frankly, some of my colleagues regarding the illiquid nature of the alternative investments. And, you know, especially in a bull market like we've been seeing over the last, 10 years, clients not understanding why, what the J curve was, understanding why a private portfolio was flat when the public markets were up 10, 15%. And, then ultimately looking for opportunities to sell, find liquidity, sell in the secondary market, things of that nature. So I guess it's two questions for you. One, how do you approach that with your clients, and how do you provide the people on this call who are raising capital comfort that they're not going to have emotionally driven, high net worth clients? And then secondly, unrelated, but partially related, I guess, is the secondary market is really becoming a very robust portfolio management solution. And getting into the retail space is like that hidden gem that everyone's trying to figure out. The high net worths who, to my earlier comment, want to exit these portfolios and these positions. But they're $50,000 commitments, $100,000 commitments. They're small little pieces. So the question related to that is this something that you're thinking about advising your clients on? Is that still too early or too small and fragmented for your practice and others that you see in the industry?
And Brian, you got a lot of experience, man. And I appreciate the comments and the questions. It's so true. So I was, thinking kind of the due diligence side of things. Lockup periods are things that we're looking at. And there's two different types of clients, right? There's high net worth clients, and then there's I just drew a blank in the phrase, but anyway, there's like a $5 million net worth, and they basically
the QP, the qualified purchaser, and the accredited investors.
Looking at the QPs, the qualified buyers, qualified purchasers, which are 5 million and up, and then looking at kind of your standard high net worth individual we call them mass affluent. It's kind of the mass affluent assets above $500,000. And as we think about things, going down market is the most profitable thing you can find. Like Apple figured out how to sell a phone to everybody, right? They don't care what we look like. They just care if we have $1,400. Like, it's genius. Like, it's the way to access mass market. I'll say that's also true about taxation. You can tax the rich, which is fine, but you also, like, taxation, the most profitable thing is taxing everybody. Like, that's kind of like the dance, right? It's if you can touch everyone. So there is a temptation to try to go down market. If you go down market, you got to have liquidity. So like CNL, Leichman Levine, like, they've developed registered products on the fund side that have quarterly liquidity. And they managed to partner with a few different vendors like Schwab or Case or ICAP. I don't know if you guys are familiar with these. These are brands that they use Mercer. They're doing a massive due diligence, guys. Like, they're going to take you over the coals. You need to have long track record if you're going to get on these platforms. That's who we use for the larger PE plays, which are very well reputable, fully due diligenced. Like, we know the terms. That's kind of that's the market that we're playing in. And the reason we do that is for safety, right? Clients, nobody, Jack, you said this, nobody calls me when the markets are up, right? That's fine, right? But it's loss. It's losses that people get very uncomfortable with. And it's not that they can't take it. We always have the prudent amount of risk, but it is very uncomfortable to see money lost or locked up if they need it. And that brings in a very prudent planning part that you're not their financial advisor, right? With that said, the know your customer thing, the temptation is going to be to take whatever they give you. But as a manager, like, I really highly would recommend that what that percentage is of a total portfolio. As you're taking money, if your aunt wants to give you 250 grand and you find out she has 260 grand, that's a problem, right? Specific, even if you trust yourself, that's an issue for her, for the whole
thing. Anything can happen.
right? Anything can happen in this world.
Someone can get sick.
Exactly. Yeah. There's so many different things. So when you're receiving money, in some ways you have to do your own due diligence. You have to turn someone down. It's real painful, I'm sure, as a burgeoning manager to say, I can't do it, right? Or I can't take this particular deal.
Yeah. And then you're also in a situation, particularly with, I think it's as the wealth grows, you keep getting the friend of friends. Hey, I've got this buddy who's launching a business, these entrepreneurial opportunities, these business plans. I want to put 50 grand into this. I want to put 10 grand into my friend's ice cream company, or, sustainable investment, or this, that, and the other. And I would imagine you're in the situation where you're trying to provide that fiduciary guidance that, might not be the best idea to purchase or to make your investment.
Yeah. I mean, once you've been around the block, you've seen enough pitch decks, and we've seen every pitch deck looks amazing. And I've never seen a pitch deck that they were like, wow, this is terrible. Like, that just doesn't even make sense. Like, ideas might not have been good, but like the financials are always strong. I mean, we have a deal we know that we still think will work out, but they're projecting 120 million of revenue in the first year or the second year, and they're at 6, right? And that hurts a little bit, but that is kind of part of the VC nature, that they just don't go where they want to go. Again, Excel always looks good. The numbers are compelling, the stories are compelling. So as an advisor, how I think about things and how I have to think, in order to get to me, guys, I'll just be straightforward. You're going to have that track record. You're probably on your second or third fund, likely on iterations. You're probably looking at audited financials. You're looking for additional capital. Probably friends and family are rolling over to the second iteration of fund. If you're not in an evergreen structure, you have multiple years track record. And again, like, you can get to, hopefully not my clients, because I want them to ask me about these things, but hopefully you can get to high net worth individuals who are not going to talk to their advisors about this, and you can do it without those things. But when they make it to mine, I really think about loss. I really think about how we're going to recall money. How are we going to get to if things go south? That's what I'm thinking about, because that matters. That's going to matter to my client. And then certainly as a percentage of their net worth and other things that we're factoring in, how much money would go toward an opportunity.
Actually, related to that, a question comes to my mind of, what is the relationship that fund managers, especially first-time fund managers, should have with their advisors? Obviously, you don't want that crossing the streams and things, but what should that relationship look like? Because it sounds to me like a pretty darn important one.
Which one? You mean if the fund manager and their personal financial advisor?
Yes.
Yeah, I would say that's kind of a business risk question you're asking, which is how much of your own capital are you putting in, right? I want to see every fund I have. We always want to see the owners, operators have their own money on they got to have skin in the game. Right. Otherwise, it doesn't work, right? So there's going to have to be some skin in the game. We'll oftentimes, depending on where the fund is. I mean, we did this with a fund about 2 years ago. They were fairly nascent. It was a hard money lending real estate fund. I actually knew the people personally, and I asked for their personal tax returns, personal statements, and corporate returns. I cannot work with bad actors. There's too much risk. So there certainly is a fairly invasive process where we're going to make sure that you have your stuff together, or the funds are, and that's why we have Mercer. Mercer does this work for KKR. We know who those people are, but again, like, our due diligence process, if it hasn't been done, we're going to need to see some personal stuff to make sure that your footing is good, right. And that the decisions get made out of desperation all the time, or out of pain, and that's a bad place to be when the rubber hits the road. Again, we're managing downside. 8% versus 9 is not going to matter. It's the minus 10 or minus 50, whatever it is, that will matter a lot.
But Joe, it would also put you into an awkward situation if one of your clients is trying to raise capital or is trying to be on the GP side of things and expect you to potentially introduce it to other clients, or, cross that line. I had that issue. And in fact, it's funny. So I had a client at my firm who was raising a first-time fund. He was an emerging manager, and we had an in-house investment program. But so out of conflict, I just use that as the excuse. No, I can't invest because, for obvious reasons. Sure. Unfortunately, that fund has gone from 200 then to now it's at 4 billion. And he reminds me of that every day because he's a client of my current firms, but that's a whole nother story. But at the end of the day, you're still conflicted as an advisor.
Oh,
Yeah.
Hey, Joe, I'm known in the business as an independent sponsor. So that means I raise money on a deal by deal basis, or pass the hat around. And I was recently approached by an RIA, and I'm still doing my due diligence here. So, I don't have all the answers, but what he's proposed is, hey, I manage X billions of dollars. If you have an opportunity, what I could do is pass the hat around amongst my clients. And they, I may get one family that may put 100% of the capital in, or I may get 10 of our families to put in, maybe 50% of the capital. You have to go figure out, where to get the other 50%. And obviously, one of the first questions I asked was compensation, and he said that he gets compensated by his clients, not from me.
That's right.
And I think it's because if he does raise money on me, that's a broker dealer issue that opens up a whole mess of other issues for him. But from my perspective, it's great, right? Because I can fundraise money from one central place. If all goes well, I theoretically deal with one investor, which is the RIA, not the individual families. But is this something that you see often?
Great question, David. And yes, the fundamental issue, my guess would be, is that any compensation you pay to the RIA would likely be considered a commission, right? It's not an actual advisory. Now, what we do or others can do is they can actually, any money that goes to an outside investment, there is some type of oversight that needs to happen, even if it's not being managed, but it'd be managed on a lower fee basis than, let's say, the other assets which are being directly managed, like actual portfolio, like stock market, stock funds, and things like that. So that is very likely. Bespoke investments for a single family, if it's just say a family office that you run into, David, that would be like one, that's fairly easy, right? They're going to want like certain positions, certain amount of equity. When you're dealing with an RIA who has many clients, if we were to bring like a limited partnership program in, or try to do our own SPV, there's just an enormous amount of work that goes into trying to wrangle that many. So being an independent sponsor creates a lot of efficiencies for the actual RIA. And so where my brain goes is anytime we're thinking about the independent sponsor or fund structure, I always think about deal flow, like what's going in there. Do we have choice? Do we have what's going to be in our fund? Are there certain requirements, or is there going to be a deal flow issue, right? Is money going to be put to work? So, but with that said, I do like the idea of funds. I do like the idea of someone with a, kind of existing experience in a particular venue, specifically their experience. I really like themed style funds. Like if someone says, I know the cyberspace extremely well, like this is what I do. We're gonna, right, cybersecurity, whatever it is, like I'm going after these 10 clients, and this like, and they hold to that. That to us is very attractive, and that's works really well.
Got it. Okay, that's very helpful. Yeah, because I found that a lot of families, at least over the last decade, and post the 2008 credit crisis, they like the optionality of selecting investments. Now, not all of us, but we do aspire to be a Steve Schwartzman or Henry Kravis. So you can just say, hey, give me $1 billion and everything will be fine. Okay, yeah. Not all of us have that capability.
Is it chilly?
But yeah. But what I found with the independent sponsor model, and nobody's more surprised at its success more than I am. And I've been doing this for 10 years. Oh, because I started off as a banker, I invested off the bank's balance sheet, then I worked for a fund. And then I remember the first, day I became an independent sponsor, I said to myself, oh my God, I'm unemployed. Now, I think having a fund opens up a number of issues, fundraising, depending upon AUM, SEC issues. And the fact that fundraising is a 24-hour, 7-day-a-week job. And yeah, that's what I've always found. And so you're starting to see even smaller groups hiring a dedicated fundraising person, because quite frankly, it's just way too much. And my strengths is analysis, it's due diligence, it's negotiating docs, it's working with companies to grow them, not necessarily calling a pension fund in middle America saying, hey guys, things are as good as it was 3 months ago. I'll see you in about another 3 months.
Yeah.
But that preparation takes a long time. So I'm seeing a lot of people get involved in this. I think some of the RIAs who are much more forward-looking are starting to be much more open to this structure.
Yeah.
What I found is if you go to some of the big brokerage companies like the UBSs and Morgan Stanleys of the world, I didn't realize it was a fireable offense. To me, it was like, okay, listen, guys, we have Blackstone on our fundraising platform. We have KKR on our fundraising platform. It's a lot easier. I'm never going to get fired for, referring Henry Kravis. But if I give money to you, David, you're kind of a single shingle guy, that's a little bit of an issue in case things go south. But with the RIAs, I'm starting to see them to be a lot more open to
they can be.
Private investment.
What I heard them saying is that the emerging managers are actually starting to perform better than what they're doing. And they're like feeding them little by little just to see the scalability of it. But the emerging managers now are becoming some of the favorites. And there are some institutions, financial institutions, specifically going after these independent sponsors and where and how can we kick in, with you? And we want to know, like, they'll do a deal or two with you at first, see how that goes. And then ultimately they're like, okay, we want to commit, lock up something with you for 10 years and it'll be a $35 million check and go have at it.
And does that feel common, Joe? I think it kind of makes sense for, folks to say, okay, yeah, I'll do a couple of co-investments for you, get comfortable, and then see if we can make a commitment down the line when you have a more committed fund. Is that something that you've sort of commonly seen? And are they generally structured like that? Do you see folks coming in with independent sponsors who's just doing a co-investment or something?
Yeah, I guess if we're defining independent sponsors as just somebody running a fund, and again, we have both. We have the major, massive ones of the world, kind of, David, what you said, like the KKR, Blackstone. We have a whole. If you look up ICAP and CAIS, CAIS, you'll see what you're up against in terms of the actual institutional PE, VC, and real estate, private credit funds, right? Those are like going to work. And we're not going to be embarrassed as advisors. Like, it's just that simple, right? But to your point, Chad, there is return. There's actually a lot of juice. There's some intrigue in smaller managers. I mean, you can play on that. You can play on the intrigue. You can play on it being bespoke. You can play on it being niche. I mean, these are all things that I think have interest and intrigue. And there's a lot of value. I mean, working with underrepresented founders. I mean, there's a lot of momentum right now in working with individuals who just traditionally wouldn't be in spaces. And I think that there is value. It's not just intriguing, it's something to do. It's actually true. And so, kind of part of the mission of Vanetta's firm is true, is there's a lot of value in places. And I think people are waking up to that, but it's always going to be measured against risk and loss.
So I got a question for you, Joe. With the current, let's say, political climate being what it is, right? And, and with things like what happened in Virginia and the close race in New Jersey now, and potentially 2022, there's a turnover in both the House and the Senate and so forth. Where do you see the appetite for investors to do you see them going more towards the independent sponsor and underrepresentation sort of as a self-correction, or do you just kind of see it just kind of being like doing the whole George Floyd thing, everyone had found their soul and was trying to support guys like me, but now they're like, okay, experiment over, and we're going to just shift back to general?
Sure.
Right.
That's a great question. And I guess I'm not sure. I hope not. I hope that we stay in this, that we stay along this track. I think that would be very unfortunate if that was a temporary thing, because I don't think that's true, right? I think though, as I look at the macroeconomics, the proliferation of PE and VC have been directly correlated with the cost of money and the consistent performance of the market. In fact, it was like, it's actually not an alternative. It was people just, I think, got a little bored of seeing consistent market returns. And then the cost of capital became so low that the growth sector has heated up, just crushed it since 2017, 2018. I mean, we've just seen an explosion. And so, Chad, I think if the inflation starts to rise, which will cause, I don't know if the Fed came out, I think it's today, we'll talk about, again, I expect tapering to stop, and I expect inflation to be called not as transitory as we thought, right? This is coming, which is going to cause some type of like blip in rates probably in 2022. And I think the markets will probably react a little bit. And I think it's going to be interesting. There's going to be some ripples. Again, real estate's been real hot. We're going to see kind of what happens there, right? And I think PE probably would be better suited than VC, maybe just because the cost of capital, and if credit tightens, it's gonna just, I think in general, regardless of what funds are being represented, I think things could tighten up. And I would hope that's more a representation of the economic condition than going backwards and not giving everybody a fair shot.
Fingers crossed. David Toll, I think you have a question.
Yeah.
Yes, I don't know how you sense that from that, but I do have a question. Joe, I'm curious. One of your clients comes to you.
Yeah.
Take me through these two scenarios. One, they heard at a cocktail party about the next Blackstone fund, and they'd like to get some exposure to it. How do you handle that kind of inquiry? And then second, same client at a cocktail party met David Acharya, and they talked about this great company that he's teed up for an independent sponsor deal. Tell me what you do.
Sure. Well, I guess in either scenario, if they're, let's say it's a stranger or if it's a client, those are two dramatically different conversations, right? As an advisor, in order to make a recommendation, and as a fiduciary, I simply have to know more about that client. So I'm happy to have a conversation. It can be high level like we're having today about private equity, about a fund that you heard about. I can ask some questions and maybe just create some interest to have the next conversation, David Toll, which would be about what is your situation? And that partly is what I go back to, is that the fund could be good. It's almost agnostic to the fund. I start with, is it a good idea for you as the client, right? Given where you are in life, if your kid's going to college next year, if you're sitting on $20 million, I don't know, right? There's all sorts of different factors, but I always start with, is it right for the person? And then, is this the right fund choice? As opposed to starting with this, is it the fund? And then we back into it. I always start with, is it right for the person? And then, is it the right fund?
Got it, Joe. And Joe, do you have, assuming let's say this is a client that you've worked with for a while, and you feel that both investments probably would work for them.
Okay.
How do you, what's the next step? So again, for a Blackstone fund, like how do you advise them to actually get exposure to that fund?
Sure.
And same with David Acharya and this great independent sponsor deal that.
Yeah. Yeah, I mean, I think it's, hopefully I have a proficiency at that point to understand like what's in the Blackstone fund, what is it doing? It's the 9th Blackstone fund of the mid cap, whatever, right? Because there's 1,000 of them. And so we will go through our due diligence and use one of those platforms, ICAP or CASE, and leverage all their due diligence and all their work. Talk to their wholesalers, talk to the people who this is their jobs is to pitch me on why they should use their fund. I mean, there's a whole, if you don't know, this is for every firm out there, there's a wholesalers who give education on their company's products, right? Whether it's BlackRock or Vanguard or everybody has somebody. And so we go to those outlets to then get as much information as we can. And we'll do the same thing, but we're going to do the same thing with David. We're going to do the same thing individually with David. We're going to go through our due diligence process. We're going to ask for financials. We're going to ask for audited. We're going to ask for track record. We're going to talk to existing investors. We're going to go through, but we're doing the work. And my expectation is that David does have to have something, and it's likely returns. It's likely familiarity. It's got to be locality. Something has to be materially different, better, tangible in order to supersede. That doesn't have to be that dramatically different, but it has to be different than the Blackstone in order to feel, for me and the client, likely to feel comfortable with it. Now, let me give you an example. We work with a lot of real estate developers and funds and hard money lending here in the DC area. We're here in DC, right? There's something to be said about being able to go up to Vermont Ave and look at the church that was converted into condos and be able to see that, right? Versus being in some REIT that invests in who knows what in San Jose, right? Like the risk profiles might be the same, or maybe even the one here might be a little bit more risky, but if I can go see it as an investor, that actually may be a much better investment because there's more comfort if something goes off, right? Or something changes. So we have to remember that individuals, we're all emotional people. We all relate to our money in a non-agnostic way. Like there's no, if you want to move, and Dave, Acharya, you said this, if you want to go to an institution, or maybe Vanessa, you said this too, institutions act differently than individuals. Right. So if you want a more kind of like hedge funds need somebody needs 6%, they're doing targeted type returns, right? You need 6, people don't say I need 6. That's very rare. Even the people that are wealthiest usually even don't peg I need 4 or I need 6, but institutions will. So if you want to go into a more academic place where you're not dealing with emotion, you're kind of dealing with employees and people who have responsibilities, a CIO, you can look for institutions, be they nonprofits, be they pension funds, whomever. They'll be a better source of capital if you want to get out of the, kind of this more skittish or emotional side.
Yeah, and I think it's really interesting that idea of safety, I think is very curious. When you're dealing with individuals, it's very sort of obvious what makes this person feel safe. And there's that similar element to safety when it comes to institutions. But like you said, there's a lot of emotional distance in the definition of safety for an institution.
Yeah, they're probably more control-oriented, target-oriented.
Exactly.
But we just had a hard money lending fund that just secured a $100 million facility from a bank in Europe. I mean, they're in their 4th or 5th year of operation. They've been in the 3rd or 4th fund, and they just they negotiated a $100 million facility. I mean, it's eminently possible. Now they're having that, and so now they have both individuals' money and they have institution, and now they have some really nice leverage inside the fund, and we feel pretty comfortable with that. So I've seen kind of this. It was an interesting mix.
Hold on, Chad. We're actually going to thank Joe for his time for today because we need to break you up into breakout rooms so you can get to know each other better. So thank you very much, Joe. This was, I feel like I should have you back maybe because this was a really great conversation. And I love I think this is a topic that is really sort of near and dear to a lot of the folks on this call who are who are the gatekeepers and what are the steps that I need. So this has been a really illuminating conversation, very illuminating for me. There's a lot that on the RIA side that I was absolutely, completely, and totally unaware of. This was fantastic. So thank you so much. And I'm going to ask if Denise has everyone in breakout rooms already. And we're going to, we will be breaking by 1:30, so we won't have as much time, but there's not that many of us here. So hopefully we can have some pretty good conversations about who we are, what we do, and potentially how we can help each other out. So I think Denise is there and has everyone in breakouts. All right.
I do need to step out, guys. I'm sorry. I will be headed out now, but I just want to say it's great to meet everybody. Thank you.
Thank you, Joe.
All right, guys.
Thank you.
Take care.
See you later.
Bye-bye.